Alright guys, taking a look at the week ahead for the trading week running from Monday the 12th to Friday the 16th of April 2021. Now this week is quite a busy schedule. We do have the start of a very exciting earnings season kicking off, starting with the big bag names, of course, as always. We also have the RBNZ coming up this week, but that is looking like it might be more of a non-event. We also have employment data for Australia, but arguably the more important one to watch in terms of the Aussie dollar would be the very important growth data that we have coming out for China. However, for us, the main event that we'll be taking aim at this week is the upcoming US CPI data and how that could potentially impact US 10-year bond yields as well as the US dollar. Now, the moment of truth for inflation has really arrived as the expected jump in price pressures from those very low base effects in 2020 finally starts to set in. And in the months ahead, especially for quarter two, the low base effects are expected to see some spectacular increases in both headline as well as core inflation. Now, even though the rise in CPI is to be expected from base effects, and even though the Fed has said that this is more transitory right now, the chances that we have some overshoot still has the potential to create sizable reactions, especially for the bond market as well as the US dollar. Now, what has been quite surprising over the past few sessions is the very lackluster price action that we've had in both the US 10-year as well as the US dollar, despite some stellar data points like the ISM manufacturing PMI hitting the highest level going back all the way to 1984, the NFP showing almost 1 million jobs added in March, as well as the ISM services PMI showing the highest print in the history of the index. Now, despite all of that, US 10-year bond yields as well as the dollar has been pushing lower. However, the US 10-year did test and hold a very key area of support between 160 and 162 on Friday, which also provided some slight reprieve for the US dollar as well. Now, what is important to keep in mind about the US dollar is that that medium-term bias for the greenback is still tilted to the downside and intact, especially in terms of the market's expectations for that reflationary environment as well as that global synchronized economic recovery. However, the market is usually also way too fast in pricing in higher rates when it comes to the Federal Reserve, and some have argued that the Fed's consistent messaging as well as the move higher in Eurodollar futures this week could also have explained some of the downside pressure. Now, also keep in mind, after a very solid push higher recently, the US dollar was arguably already due for some downward mean reversion anyway, and the drift lower in US 10-year bond yields basically exacerbated the push lower. Now, when it comes to other instruments, we've maintained a bearish bias for gold basically from the start of the year, or since the start of that big push at the upside in US 10-year yields, which was, of course, coming on the back of that Georgia election runoff that we had on the 6th of January. And we've also maintained a bullish bias for something like the dollar yen. Both gold as well as the dollar yen has largely been at the mercy of flows in US 10-year bond yields. And of course, due to the impact that something like inflation data can have on bonds and thus bond yields, this week's upcoming US CPI data will arguably be one of the most important events in a very busy economic data week ahead, and depending on the outcome could create some fantastic opportunities in various asset classes as well as instruments. Now, it's going to be a busy week, like we said, in terms of economic data, with attention turning back to US 10-year as well as 30-year bond auctions, as well as retail sales coming out of the US, but arguably, like we said, the main event will be that March inflation data. Now, the Fed has made it very clear recently that they are not concerned at all about the expected moves higher in inflation, as they do see it mainly as transitory and largely as a result of those easy base effects in 2020. Also, fears of runaway inflation has recently been more muted because we've had core inflation actually surprise to the downside during the last two prints that we've seen. Now, there was something interesting though that Fed Chair Powell explained in that last meeting they had back in March. And that is that it's one thing to say that they will ignore and allow a possible overshoot of inflation, and it's quite another to actually ignore and allow inflation to overshoot. And that, of course, makes incoming CPI data all the more important right now, especially with some very convincing arguments from a particular few participants about the possibility of inflation actually overshooting by a larger margin and possibly also having some legs to remain higher for longer than the Fed is currently anticipating. Now, some of the recent data has implied the possibility of inflation overshooting meaningfully, at least in the short term. Some of that was the ISM manufacturing as well as services prices paid, which here can be seen in the green as well as the purple lines. Both of these two readings jolted to multi-decade highs in their recent prints, showing that input prices have continued to rise as order books remain jam-packed while inventories remain too low to basically keep up with that demand. Furthermore, we had Friday's PPI year-over-year, final demand, as well as core PPI, which can be seen in blue and red here, coming in at the highest levels going back to 2011. And even though a lot of that is obviously due to those lower base effects, Wells Fargo has highlighted that PPI has surged almost 12% annualized just from the start of the year. So it's not just base effects for the reason for that push to the upside. Now, with rising ISM prices paid, as well as rising PPIs, as well as higher commodity prices recently, which can of course have spillover effects into the core CPI, even though it is stripped out of that headline number, there is credence to the view that inflation could overshoot for higher and longer than the Fed is currently anticipating. And according to a recent post or report by ING, they've stated that the implications of all of this means that manufacturers potentially now have the sort of pricing power we haven't seen in years, with greater scope to pass these prices on to customers. The obvious implication is that risks are increasingly moving in the direction of higher CPI readings. Now, Wells Fargo and ING are not alone in their expectation that inflation could overshoot for higher and longer. We also have Nordea Investment Bank, which has noted in a recent report that small businesses are trying to pass on higher prices to their customers at the fastest pace really on record. Furthermore, they've also highlighted that gasoline prices were up 40% year over year in March alone, and that historically can have a tendency to spill over into something like core inflation measures, especially to the core PCE deflator. So what exactly are the markets expecting from this week's CPI print? Well, if we take a look at the expectations, we can see headline CPI year over year is expected at 2.5% from a prior of 1.7, with a minimum and a maximum of 2.3 and 2.6. And looking at that core measure year over year, expected at 1.6 from 1.3, with a high and a low of 1.5 and 1.7. Now, coming back to the bond market, the other data to watch for its implication on the bond market will be the upcoming 10-year as well as the 30-year bond auctions coming up on Monday. Now, even though there is far less attention on these compared to the ones that we had at the start of March, they can still pack a punch for bond markets if we do see some dismal take-ups in terms of that bid to cover ratios. Now, of course, the other event to watch for bond yields as well as the US dollar will be Thursday's retail sales, where consensus is looking for a print close to 6% after that expected boost from newly issued stimulus checks that we had rolling out in March. But as retail sales are due later in the week, the main focus for bonds will be firstly that auctions coming up on Monday, and then CPI on Tuesday. And any major surprises will be very important for the bond market and could provide some excellent trading opportunities in the US dollar and more specifically in USD yen as well as gold. So looking at some potential sentiment shifts, the first one we'll be looking at, like we said, is those bond auctions. If we do see very, very high bid to cover ratios coming out for those bond auctions, we would expect that to weigh on US 10-year yields. As an implication of that, we'll also expect some weakness in the dollar, downside pressure in USD yen, and upside pressure in gold. Another bearish catalyst would be if US CPI or that core print comes in below the market's minimum expectation, expecting that to have a similar reaction in terms of asset impact. And then we're also looking at retail sales, a print below that in terms of minimum expectation will also have the similar type of expected reaction for US 10-year bond yields as well as the dollar, USD yen, and gold. Turning then to potential bullish outcomes, just the exact opposite. If we get a very, very, very low bid to cover ratio for those 10-year and 30-year bond auctions, we would expect that to see upside pressure in US 10-year bond yields. We would expect that to translate into strength for the dollar, upside momentum in USD yen, and downside pressure in gold. Similarly to the bearish factors, with the bullish one looking at core and CPI, if we see that printing above the market's maximum expectations, similar asset price reaction there expected, upside in yields, upside in the dollar, upside in USD yen, downside in gold. And then of course looking at retail sales, if we see that printing in above the market's maximum expectation, expecting that to see the similar type of reaction in the markets. Now do keep in mind that the possible bullish and bearish catalysts you're seeing here are not necessarily dependent on each other, and they are not ranked in order of importance. Each catalyst that you see here has the potential to be either bullish or bearish in their own right. But of course, if they are combined by other similar bearish or bullish catalysts, we are expected that to see a bigger bearish or a bigger bullish reaction in the markets. Do also remember that the potential outcomes in terms of the asset impact isn't a fixed rule. The markets can always surprise in the way that it reacts. So the expected impact is never intended as a trade call, but rather intended as a guideline for you to use in your own framework for your scenario planning in the week ahead. All right, that is everything from our side for this week ahead video, guys. Hope you guys will have a fantastic trading week ahead. As always, if there's any questions, don't hesitate to let us know.